Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Newell Brands Inc. Annual Report. Newell Brands Inc. offers a diverse range of products and services across various segments. In the Home and Commercial Solutions segment, the company provides commercial cleaning and maintenance solutions under brands such as Rubbermaid and Spontex. It also offers household products like kitchen appliances from Crock-Pot, Mr. Coffee, and Oster, as well as small appliances from Breville in Europe. In addition to these offerings, Newell Brands Inc. provides home fragrance products through Woodwick and Yankee Candle brands. The company's Learning and Development segment caters to educational needs with writing instruments, art products, labeling solutions, and baby gear under various brands such as Dymo, Elmer's, and Sharpie. The Outdoor and Recreation segment offers outdoor-related products including technical apparel from Camping Gas, Coleman, Contigo, and Marmot. The company serves a wide range of customers including warehouse clubs, department stores, specialty retailers, office superstores, contract stationers, e-commerce retailers, and direct-to-consumer online sales. Newell Brands Inc.'s extensive product portfolio includes commercial cleaning and maintenance solutions, household products, kitchen appliances, small appliances, home fragrance products, writing instruments and art supplies, baby gear and infant care products, outdoor and outdoor-related products, technical apparel, on-the-go beverageware. Unfortunately, I do not have access to the text you provided. However, I can still provide a general overview essay on what might cause a stock price to drop. The stock price of Newell Brands Inc. has dropped significantly over the past year due to various factors that have impacted the company's performance and investor confidence. One major reason is the decline in sales revenue, which has been affected by changes in consumer behavior and preferences. The shift towards online shopping and e-commerce has disrupted traditional retail channels, making it challenging for companies like Newell Brands Inc. to adapt. Another factor contributing to the stock price drop is the company's struggles with debt repayment. Newell Brands Inc. had taken on significant debt to finance its acquisition of Jarden Corporation in 2016. However, the company's efforts to pay off this debt have been hindered by declining sales and revenue. This has led to concerns among investors about the company's ability to meet its financial obligations. Additionally, the company's failure to innovate and adapt to changing market trends has also contributed to its stock price drop. Newell Brands Inc. has faced criticism for its slow response to emerging technologies and consumer preferences, such as the rise of smart home devices and e-commerce platforms. This lack of innovation has made it difficult for the company to stay competitive in a rapidly evolving market. Lastly, external factors such as economic uncertainty and global trade tensions have also had an impact on Newell Brands Inc.'s stock price. The ongoing COVID-19 pandemic has further exacerbated these challenges, leading to a decline in consumer spending and a decrease in demand for certain products. Newell Brands Inc. maintains a market capitalization of $2 billion, broadly in line with the industry peer group. Newell Brands Inc. trades at a lower price-to-book ratio of 0.82 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The leverage on the balance sheet appears elevated, with liabilities of 75% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has weakened over the past 5 years, accompanied by declining or negative operating income. This suggests the business may be eroding shareholder value and warrants caution. The company has consistently reduced its share count, reflecting a shareholder-friendly approach to capital allocation. The company have a dividend yield of 5.96%. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline for a company can be attributed to several key factors. Firstly, changes in global market conditions such as inflationary pressure and rising interest rates can lead to softening demand, resulting in revenue decline. Additionally, the implementation of cost-saving measures through workforce reduction and store closures, as seen in the Global Productivity Plan 2025, can also impact revenue growth. Furthermore, downward revisions of forecasted revenue and distribution losses can further exacerbate revenue decline. The company's segment-wise analysis reveals that certain segments such as home and commercial solutions and outdoor and recreation have experienced revenue decreases from 2024 to 2025. Geographic net sales data also indicates a decrease in revenue for the United States and total North America regions. However, it is worth noting that some segments, such as learning and development, have shown an increase in revenue from 2023 to 2024. Overall, the company's revenue growth or decline drivers are influenced by a combination of global market conditions, operational efficiency improvements, and product demand. Net income for the company decreased significantly from 2024 to 2025. The net loss increased by $69 million, a 31.9% rise, resulting in a net loss of -$285 million in 2025. This decline was largely due to restructuring charges that added $82 million to the net loss. However, impairment charges contributed positively, increasing net income by $340 million. Profit margins also experienced a downturn. The operating income margin decreased from 0.9% in 2024 to 0.5% in 2025, indicating a decline in profitability. On the other hand, the gross profit margin improved slightly, rising by 0.2% to 33.8%. This improvement was offset by lower sales volumes and additional tariffs. The reasons behind these changes are multifaceted. Soft demand across various segments, including H and CS and O and R, contributed to the decline in net income and profit margins. Net distribution losses and product line exits further exacerbated the situation. Additionally, unfavorable impacts from foreign currency fluctuations added to the challenges faced by the company. While gross productivity and pricing improvements attempted to offset these effects, they were ultimately insufficient to mitigate the overall decline. The company's financial performance indicates a strong ability to generate cash from its core operations. According to the provided information, in 2025, the net cash provided by operating activities was a positive $264 million. This is a significant indicator that the company is able to cover its expenses and generate excess funds through its day-to-day business activities. Furthermore, as confirmed on page 50, the company's balance sheet shows a positive operating cash flow with a balance of $11 million at the end of 2025. This suggests that the company has been successful in managing its finances effectively, generating sufficient cash to meet its obligations and invest in growth opportunities. Overall, these figures demonstrate that the company is indeed generating positive operating cash flow, which is a crucial aspect of its financial health. The company's debt level has undergone significant changes over the past few years. According to the extracted summaries, the debt level increased by $100 million from December 31, 2024 to December 31, 2025, and also rose from $4,718 million to $8,414 million during this period. Additionally, long-term debt saw a modest increase of $35 million from $4,508 million in 2024 to $4,543 million in 2025. The interest expenses have also seen a substantial rise. The net interest expense increased by 8.8% from 2024 to 2025, reaching $321 million in 2025 compared to $295 million in 2024. Furthermore, the interest expenses rose by approximately $5 million on an annualized basis due to rating downgrades. These increases suggest that both debt level and interest expenses have changed significantly over time. The performance of various segments and regions has been a mixed bag in recent years. On the positive side, home and commercial solutions, learning and development, and outdoor and recreation have all performed well. E-commerce retailers have also seen significant growth. In terms of regions, while there is no specific information on Europe or North America's performance, Asia has not been mentioned as underperforming. However, some segments and regions have faced challenges. Foreign currency translation adjustments have been a concern in 2025 and 2023, resulting in losses of $64 million and $20 million respectively. The U.S. market was also affected by restructuring activities, while the international region has borne the brunt of restructuring-related charges. Despite these setbacks, it is clear that certain segments and regions are driving growth and success for the company. Management is emphasizing the importance of continued investment in leading brands, advertising, and e-commerce initiatives for long-term success. The company's turnaround strategy, initiated in 2023, is ongoing with two key plans. The realignment plan, which aims to simplify processes and redirect resources by the end of FY25, and the productivity plan, announced in December 2025, which focuses on streamlining overhead and driving operational efficiencies. The company is confident in its ability to navigate the current tariff environment due to its significant U.S. manufacturing presence and centralized procurement team. However, this confidence comes with a cost, as management expects to record $75–90 million of restructuring charges by the end of 2026 related to the productivity plan. To drive growth and efficiency, the company is implementing several initiatives, including standardization, simplifying its North American distribution network through the Network Optimization Project, and leveraging scale to reduce complexity with Project Phoenix. These efforts are expected to yield significant benefits in terms of operational efficiencies and cost savings. The company has made several acquisitions and divestitures over the years. In terms of acquisitions, it is stated that the company may continue to pursue acquisitions from third parties, although no specific deals are mentioned in the report. On the other hand, there have been several notable divestitures. The company sold its equity interest in a joint venture for a pre-tax gain of $12 million in 2025. Additionally, it completed unspecified divestitures and reported business exits as a factor contributing to net sales decline in 2025. Furthermore, the company liquidated various subsidiaries in different countries, including Canada, Netherlands, Russia, Luxembourg, and Hong Kong. The company also recorded an impairment charge of $241 million for goodwill associated with the baby reporting unit in 2023. This is not a traditional sale, but rather an impairment of existing goodwill. Overall, these acquisitions and divestitures reflect the company's efforts to adapt to changing market conditions and optimize its portfolio. The company's financial activities have been transparent in certain aspects. One notable aspect is the payment of dividends to its shareholders. According to the provided information, the company has indeed paid dividends for the years 2023, 2024, and 2025. This indicates a commitment to rewarding its investors through regular dividend payments. However, there is limited information available regarding share buybacks. Despite this lack of clarity, it can be inferred that the company's primary focus has been on distributing profits to shareholders in the form of dividends rather than repurchasing shares. Concerns about inventory buildup and supply chain disruption. There are growing concerns about inventory buildup and supply chain disruption. One potential consequence is supply chain disruption due to climate change, which can lead to disruptions in production and distribution, page 19. Additionally, announced and/or imposed tariffs on foreign imports into the U.S. have caused supply chain disruptions, page 35. The situation has worsened with retailers rebalancing their inventory levels, leading to concerns about inventory buildup, page 38. Furthermore, supply chain disruptions are also caused by geopolitical and macroeconomic conditions, labor shortages, transportation issues, raw materials unavailability, and sourced products scarcity. Tariffs imposed by the U.S. and retaliatory tariffs from foreign countries have also contributed to these disruptions. The data shows a significant increase in finished product inventory, rising by $105 million from 2024 to 2025, page 56. This trend indicates that retailers are struggling to manage their inventory levels effectively, leading to concerns about potential stockpiling and supply chain disruption. Overall, the current situation suggests that there is a pressing need for companies to reassess their supply chain management strategies to mitigate these risks. That concludes the financial summary for Newell Brands Inc. Feel free to comment below, and I will be happy to answer them when possible.